of how we got to our strategy. Trading in the 1980s, you had something as simple as moving averages. Some of you might know this, all right? People would look at sterling US dollar, they'd look at some moving averages and say, oh, you know what? The price is below the average it's been for the last 10, 20, 30 periods, or 200 periods, or 50 periods, whatever it is. And because the price is below its longer term average, it's likely to move back to the average. It'll revert back to mean. So they'd use these kind of simple strategies, and they used to work in the 80s. And then more people started using them. And some people said, oh, no, I don't want to look at the daily average, what the price has been over the last 200 days. I'm going to look at what it's been over the last 50 days or the last 50 minutes. And so you had all these people moving and pulling in different directions using the same methodologies. And so you had the markets going volatile, and then that approach stopped working. Okay. Because some were buying, some were going short because they were looking at different times. So then in the 1990s, people moved using a bit of computers, but also just using not too much computing power, but a little bit of computer. And they started looking at pattern recognition. In the 1990s, they thought, oh, why don't we look at patterns? And why don't we look to see if over the last, say, 10 periods, if there's certain patterns, then the price moved up. There was a pattern, then the price moved up. Oh, what if that pattern repeats itself? And they started doing this. And then they quickly discovered, actually, you need a lot of data. Just because it was a blue sky today and the market moved up doesn't mean every time there's blue skies, the market's going to move up. So this pattern recognition was limited by people's misunderstanding of statistics. And it worked to some extent, but it needed refining, okay? And the reason I'm explaining all of this is because we're going to use all of this. We're going to use pattern recognition, but not the way it used to happen in the 1990s. We're going to use computers. So I'm going to bring you guys all up to speed, all right? Because the part of the problem's been, and you'll know this if you've been reading my columns or hearing me on TV, is part of the problem's been that a lot of private investors have not been brought up to speed by the professionals, by the institutions onto what's happening. So they're lagging. You're lagging. That's why you're losing money. Okay, so then you had in the 2000s, people started using even more computer, more software came out, and they started using indicators and more computers. So they used the MACD, they used the stochastic, the RSI more and more, and they said, oh, these indicators will smooth out some of these moves and it'll make it easier. So is the market oversold? If all these indicators are at the bottom half, it must mean the market's oversold and therefore we should buy. And that avoided some of the problems of pattern recognition because they're using these multiple indicators, removed some of the problems of moving averages because these things were more sophisticated. But again, it suffered from the same problems very quickly. People started looking at these things in different time frames, and some were saying, oh no, that means to buy, this means to sell, let's go against it. And all of a sudden you had a mess. Okay, so all these indicators work some of the time, but not often enough. Nothing worked all the time. So what do we then do? All right, and the problem then became, at the same time, a whole bunch of trading educators came along. Okay, around the 2000s, they started charging thousands, and they started advertising on places like Facebook in the 2010s. This is my Facebook page where somebody's put an advert up. And saying, oh, pay us £5,000 and we'll teach you how to trade with all the looking all compute. Okay, so that's then the evolution of what happened. And they shove you in classrooms, they charge you a fortune, you got hotel fees and all the rest of it because they realized, ooh, it's getting complexity. Wherever there's complexity, there's money to be made. Okay, and they said, oh, look, there's Elliott waves and there's Fibonacci and all of this, which is prehistoric. I mean, it just doesn't work anymore. And others said, no, don't worry. There's so much data. Let us spend hours teaching you earnings per share and valuations and EBITDA. Remember EBITDA used to be so popular, okay? And the problem then became, people said, well, yeah, we'll pay thousands for that. Then they said, oh, wait a minute, now we can get data from banks. Look, we can get bank forecasts. This is 2017 where the HSBC said, oh, this is what's going to happen with the pound. Okay, 1.1. Guess what? Didn't happen. The banks started getting it wrong, but their data was available. So private investors said, oh, we'll follow what the banks are doing. We'll follow what Goldman Sachs is doing. UBS is following. This is from 2017. I kept those headlines. And just to show you, 2017 January, Goldman Sachs got it wrong regarding the dollar and the euro. UBS got it wrong with euro dollar, okay? One said go short, one said go long. Both bloody got it wrong.